we'll be using ratio analysis. Right. So now, how do we properly comment ratios? How do we properly comment on these ratios? So, in addition to calculating and commenting on these ratios over a period of time, it is important to compare the entity's performance with the industrial norms, okay, with industrial norms or industrial measures, industrial performance, and the likes, and also possibly its competitors. So, to provide insightful comments, it is necessary for you to have the basic knowledge of the internal as well as the external environment where this company operates. You need to know the nature of the business, the nature of the business environment, its products, the types of products that they are selling, types of operations, type of a sector, industry, and the likes. Even more important, to interpret these ratios, a common problem now is simply, to state a certain ratio as increase or decrease from one year to the next, which is insufficient at this level. We can't comment to say gross profit has increased, current ratio has decreased. That is insufficient at this level. So as value-adding comments, these comments, the value-adding comments should then be provided given the knowledge that we have from the internal and external environment of that company. Right? So this may include an explanation of why. Okay, so this may include an explanation of why this has happened. Why do we have a decrease? Why do we have an increase? Okay, why do we have that particular change? Okay, why do we have such things there? Okay, right? And also we have got another thing that we also need to know, right? Is on what impact this is likely to have. What impact this is likely to have, right? It's also another thing that we need to consider. Remember, sorry, I was actually trying to make this be able to type, right? So why this has happened, right? So what impact this is likely to have, right? What impact? So here I'll just add what impact this is likely to have. Why this has happened. Why this has happened, right? And possibly you need to provide the corrective measures. So what remedial, okay, what remedial, forgive me if I misspell some of these words, I'm trying to be fast so that our video will be very short, right? What remedial actions may be required to address this issue? So you then see that we will have at least we are now on an informed position if we are to add some of these things that I've highlighted to our ratios that we commented. So instead of you saying there is an increase in gross profit, we would want to know why there is an increase in gross profit. So we're now looking on the factors. If you could analyze from the SWOT analysis, we want to know the factors that have contributed to that increase, right? And what impact is this going to have to our company, right? Also to our environment, right? And if it's going to be a negative impact, what remedial action can we also do, right? So basically we're giving a recommendation, okay, on what should be done, right? So after all this, we will start with profitability, ratios. Okay, we'll start with profitability ratios. So I do have a lot of profitability ratios that I have here, and remember, these ratios, we do not have a standard for ratios. Ratios are customized as long as they mean something. Ratios are customized as long as they mean something. But these are basic or standard ratios that we have. Right. Basically, we start with changes in revenue, which is actually important as well, where we are comparing the current year revenue with the previous revenue, so express it as a percentage change, right? Then we've got the gross profit margin, where we say gross profit over revenue, right? Remember, gross profit also is as a result of revenue minus cost of sales. Then we've got a change in gross profit percentage. Take note of the difference between the gross profit margin percentage as well as a change in the gross profit, right? A change in the gross profit. These are slightly, if we'll see when we're now doing the practical illustrations, the difference between the two, right? So operating profit margin and the likes, the earnings before interest, right? We do have a lot of them. The degree of operating leverage, right? The degree of operating leverage is given as a ratio, right? We also have got effective interest rate, right? All these things we use them to analyze performance. So the last one, which is our earnings per share, we are going to possibly do it as a standalone topic. So this one I will not consider it under profitability for now, right? So I do have only two illustrations just to demonstrate on how we are supposed to comment on ratios. I can't actually give you all the interpretation of all these ratios, but I just want to highlight and give you a guidance on what we expect at this level. So I have got this illustration on revenue here, right? Illustration on revenue here. So I have got these 2 years, 2021 to 2022, 2021 to 2022. Right, for 2021, we've got revenue of 783,281. Then in 2022, it has improved by it has improved to 916,440, right? But we've got additional information that will be provided, obviously, if it is a question, right? So we're given that inflation in 2022 is 6%, okay? Inflation in 2022 is 6%. Then we also have got industrial growth in revenue, the industrial growth in revenue. So this is now sort of like a yardstick to compare against the industrial measures, the industrial yardstick, right? So we're told that is 12%, right? So if I move a little bit here, right? So what I've done, I have actually set sort of like two scenarios here. I have got the fundamental level. This is the level that we were using maybe when we were doing our bachelor's, right? So what were we doing there? We would calculate the percentage change in our revenue. Remember, percentage change in our revenue has to be the new minus old, right? The new minus old, which is 2022, sorry, the new minus old 21 over the old, right? The new minus old over the old. So that was our calculation there. So basically this will give us a growth of 17%. This gives us a growth of 17%. So basically the change, let me do this, move the text. right? Basically the change, if I to calculate here, let me just calculate this one, right? So if I say this over the old 73222, right? So if I calculate the change with the formula that I've just highlighted there, right, this is what I get is 0.1699. So basically it's 17%, so we can deduce this to 17%. So there is a growth in terms of our revenue by 17%. Now, this is what we'll then analyze under fundamental level. So say the company showed a good growth in revenue of 17% from 2021 to 2022. So the first statement here is it's what we call an observation, right? So the first statement is what we say just an observation, like it's you see what is there. All of us can see what is there. There is an improvement by 17%. But now, an observation is not enough. I've seen from previous students, from previous class, there are some who actually went on to comment the rest of the question, saying there's an increase, there's a decrease, there's an increase, there's a decrease, there's a slightly change, there's this, there's that, right? They were not adding value to their comments. Okay, so here I started with an observation where I said the company showed a good growth in revenue of 70% from 2021 to 2022. Okay, the revenue also grew at a faster or better rate than the industrial growth of 12%. Remember, we're given the 12%, so I'm just comparing our 17% as compared to the industry, right? So, increase in the company's revenue could be due to increase in market share, okay? Increase in market share or effective marketing of the sales department. So here I have actually added something there. I've actually added something there why this change happened. I'm giving a reason what could have contributed to this change. So it might be that there was an increase in market share or effective marketing of the sales department, right? So basically that's what we would do at fundamental level. But at this level, I am expecting what I deem to call an advanced level under applied corporate reporting. So if we go back to our scenario here, the change here, 17%, has been calculated from the monetary elements. Right. So monetary elements, remember, also include inflation. It also includes inflation. Okay, it also includes inflation. Okay, that's monetary elements. So if you take figures as they are, as reported, those figures might have increased due to inflation. Remember, when there's inflation, the prices of 2021 will then be different with the prices of 2022. So sometimes if you don't consider the inflation into your analysis, you may think that you are doing well. Right? You may think that you are doing well, but maybe the figure will just arise due to inflation. It's just like, for example, in Zimbabwe, right? In Zimbabwe, if you sell a loaf of bread in May, a loaf of bread right now is going for 1,600 bond, right? 1,600 bond. That's a loaf of bread. But now in July, if you want to compare, maybe you sell that single loaf of bread, it will now be possibly 2,500, right? It will now be 2,500. But now, both of them, they're still revenue. Right? Both of them, they're still revenue. So you'd say, I have improved from 2,500, from 1,600 to 2,500. But still, you have sold just a single bread on both of these months. So we need to factor in inflation as compared to, so in July as compared to May, so that we see the real performance here. You can see here nothing changed, but in the monetary things, yes, it changed, right? So what we then do is we need to consider this inflation. Okay, we need to consider this inflation as well when we do our monetary items, when we deal with our monetary elements, not ratios, but our monetary elements. Right. So if we factor in inflation, right, remember the formula for real interests, right? So if you want to see the real growth, we would say 1 plus the monetary interests is equals to 1 plus the real interest, which means the real change. That real change is multiplied by 1 plus I for inflation, if you still remember this formula under the purchasing power parity, right? So our figures are given in monetary, so it means our ratio that we've calculated there is also in monetary. So what we do is we then come here and say 1 plus 70%, 70% that is in monetary, right, is equals to 1 plus, so I want to see the real change. The real change means the real interest multiplied by 1 plus our inflation rate is 0.06. 0.06, sorry. Right, so if you make R the subject of the formula, we're supposed to get the real change, right? The real change is 10%, right? Is 10%. Okay, so if you compute this, your real change should then be 10%, right? So now, if I am here to comment, in general, if I just take it at monetary value, I see that there's a change of 17. If I factor in inflation, the real change is actually 10%. I have removed those increases in selling prices and stuff like that due to inflation. So my comment will be, the company's revenue generation performance has improved by 17% from 2021 to 2022. Remember, I said the first statement normally is an observation. It's what we are all seeing, or what we can all see, right? So the company's revenue generation performance is improved by 17% from 2021 to 2022. This is good considering that the revenue grew in excess. The revenue grew in excess of inflation of 6%. So I know that there is an improvement there. Okay, because the real growth is 10%. Remember, our inflation is what? 6%. Right, so it has grew in excess of inflation. So I know that this growth now is not due to inflation, but it is the real growth. Right, and with a real growth per year equal to 10%. The contributing factors of this growth may be the effective marketing and pricing strategies employed, or it might be improved market share by venturing into new markets, stroke new customer segments, or improving product offering, maybe improving customer services, or it might be improvement in the disposable income of consumers, that is improved demand, or it might be innovative strategies that gave the company a competitive advantage over its competitors. So if you see here, what we did is we tried to unpack the change of 17%. We tried to unpack, to reveal what really happened, what has caused this change. So that's why we had to also apply the inflation, so that we're left with 10%. right? Then here, contributing factors. Why has this happened? What has led to this change, right? Now, I was just analyzing from the internal perspective, things that are within the company's control, because you can actually control your marketing and pricing strategies. You can actually improve your market share by venturing into new markets, as well as new customer segments, improving product services offering, right? So that's what I also do. But I have also to highlight an external factor that is beyond my control, right? In general, if we remember what normally happens even in Zimbabwe, whenever civil servants get an increase in their salaries, we have got queues by the banks, we have got many people in shops, that is if when there is an improvement in their revenue. But that one is actually an external factor. Improvement in the disposable income of consumers may also improve demand. I have highlighted an external factor as well. So if you go through this, this is what we expect at